But, it's been really interesting to note that, M&A activity has remained relatively robust. And I think that has to do with the fact that, balance sheets in corporate America are pretty strong as a result of the fact that corporations had years here to borrow money at low interest rates. And, when you look at deals that are getting announced these days, like, Tenneco, that I believe Apollo is doing, there seems to be no slowdown in M&A activity or financial transactions.
Diane Swonk, let me go to you on the partition of GDP. It's been a theme for us, and it's something that the Fed has to confront. GDP is being held up essentially by net exports as a generalization. How flat on its back is the American economy right now? I think I lost Diane. Diane, are you there?
Oh, sorry. Okay.
Yeah. Okay. How flat on its back is Diane? How flat on its back is the American economy right now?
Well, it's interesting that the majority of Americans think we're either in a recession or on the edge of a recession, and that's because inflation has eroded all that they've gained in wages and then some. So they do feel like they're losing ground. But it really is pretty fascinating to see how much the consumer slowed this year, despite all the excess savings that they have and all they tap, despite 3.8 million jobs being created year to date, the second largest annual number since 1984, only seen in 2021. It's something that Rich made a point about, is how much the economy has slowed, and that's before all these lags have taken effect. So we've seen quite a significant slowdown in the U.S. economy. And on the trade side, I think it's really important to look at, we've got a strong dollar, we've got weakening growth abroad. Growth abroad is weakening more rapidly than it is here. The trade deficit's not going to provide the buffer that it did as we go into recession either. Now, this isn't going to be the same kind of recession we had in 2008, 2009, or the pandemic recession. We've got a lot of pent-up demand in services, but the goods side of it is already contracting. And we're going to see more contraction in the goods side. We saw factory orders fall quite dramatically in September, and led by export orders. Those are really important things to think of when we're looking at the trade deficit helping us out. And I think that is, with a strong dollar and the kind of global scenario we have, and the ricochet effects. When the Fed raises rates, they ricochet around the world, and the risk is that they come back and shoot us in our own foot. And I think that's really important to understand right now. The Fed gets it, but they also do believe that in order to derail, with all that slowdown, inflation has still been persistent, and that means they believe they've got to raise unemployment in order to really bring demand to meet what they see as a supply-constrained world.
And Diane, you know how politically sensitive that's becoming, increasingly so, over the last couple of weeks. The White House Press Secretary, Karine Jean-Pierre, just said, our view is that the Fed is an independent agency, and we respect their independence. The Fed actions help bring inflation down. The White House has been pretty down the line about this, straight down the middle. Other Democratic senators have not been. Dan, how do you think this Fed, this institution, will handle the politics of this moment?
Well, we've really seen, Jay Powell is remarkably good at the politics of this, and he's had to weather a lot in his tenure in terms of political influence, let's just say. And I'm amazed at how little that actually phases him. It is going to be hard. Remember, Paul Volcker was dealing with, protests. People were sending him keys to the homes they weren't selling. They were sending him keys to the cars they weren't selling. He was, this was not an easy thing at all. Don Cohn, who worked for Paul Volcker back in the day, Paul Volcker would give them sort of symbolic Purple Hearts when they would go out and do listen events and have people complain about the hardship that the Federal Reserve was doing to the economy. So this is not new, and it's not new for this Fed chairman.
Dan,
either.
Some people might
and
argue
I think that's important.
That it hasn't started, that that's still in their future, and that the pass they get at the moment is because at the moment that your mandate is not in conflict. The labour market data of the last few months has confirmed that. Dan, do you think that is in their future?
Absolutely. It's going to get really hard when you've got both inflation not cooling as fast as you'd like, and you've got unemployment rising. That is just, not a good situation to have. As I've often, said, you have to think of inflation like a cancer. You got to treat it. It's not pleasant, but if you don't treat it, it can metastasize and become a much more acute and chronic condition that could even be fatal. That is the decision the Fed is making. That is not an easy choice to make, and they know it. And I think that's the important thing, is they know it. That said, that doesn't mean the politics of this are going to get pretty. They're going to get a lot uglier over the next 6 months.
Man, the skepticism right now around this pivot, I just have to reset. We got this Fed decision at 75 basis points. The market's treating this like a pivot. On Twitter, still not a pivot. Man, people are desperate. A pivot was when they cut. Here's another one. Fed acknowledges reality, and that's a bull's pivot? LOL. Okay. And I do wonder, Scott, there is this incredible skepticism around the market response, and I do wonder how much this is just simply because they're just having a separate conversation, by the way, about what LOL means. But in the meantime, how much we haven't necessarily seen the balance sheet reduction actually feed into the markets. When do we actually see the effect of that? And is that draining of liquidity what's going to ultimately trigger something that feels more realistic, maybe?
I think so, Lisa. I mean, look, Diane made some very interesting points, and that is that if we look at the economy right now, the first and second quarter contracted. The only reason the third quarter printed positive was inventory accumulation, which is telling you that, the consumer's already, in retreat. So, I think this is going to sneak up on them at the end of the day. And, I do agree with what Diane said, that, I think prices will slow much faster than the Fed anticipates. Owner equivalent rent, which is, one of the biggest pieces in the PCE, everything else is slowing down. It lags. So, as housing softens, we're going to see more downward pressure there. So, I want to stop short here. I would not call this a pivot today. I think that the slowing of tightening is not an easing. I think the Fed is just saying, hey, let's be careful and understand we have to get to the destination. And before they get to the destination, I think it's likely they're going to create a lot of damage to the economy and financial markets.
Scott, we can see that they're setting up the flags. It's about 5 minutes away from Fed Chair Jay Powell taking the helm. What would you ask him today?
I would ask him that, look, this was a great artful piece of language. I salute them for it. But at the end of the day, where do you see the terminal rate, and where do you see policy being restrictive enough relative to neutral before, that you basically just say, hey, we're restrictive. We don't have to do more, and let inflation burn itself out and stop, increasing rates.
Diane, a question I asked Dr. Clarida, and appropriate for you as well. Is the Phillips curve dead? I mean, I look at the cumulative moment of what we've had, and I really wonder about the underlying theories driving cumulative tightening. How's the Phillips curve doing this afternoon?
Well, I think the bottom line is the labor market, it's not a wage price spiral, but the labor market is adding to costs. The idea that, we're likely to see a reduction in the number of people out sick due to COVID this month, but we could see an increase in people who have to take care of their kids because we have this other crazy respiratory disease, RSV, which is filling up ICUs around the country. Those staffing shortages that are being created by the legacy effects of COVID, along with the acute shortages that we have, are costly, even as wages plateau. And I think that's really important to remember. And that's something the Fed is taking into account, that, we still have inflation. We've got inflation with an economy that's slowing, but it also was underpinned by 3.8 million job gains. And I think at the end of the day, that's the part that they target.
Dan Swank. Dan, just wonderful, as always, alongside Scott Minerd. Scott, thanks to you, buddy, as always. About 3 minutes away from the start of this news conference. This is how the market's behaving, up 0.5% on the S&P 500 and on the Nasdaq too, up 0.6%, there and thereabouts on the S&P 500. Elsewhere in the bond market, shaping up as follows: down hard at the front end by 8 basis points, 447. A dovish interpretation as the Fed tells you basically what the Fed had already told you. We can get to that in just a moment. On On a 10-year, we're down about 3 basis points at about 4%.
John, I want to emphasize,
Sure.
we were making jokes earlier that this is going to be a snooze fest, or we were just going to go through it waiting for December. All of a sudden, I'm not waiting for December. I'm waiting for 10 minutes from now when the questions come in to Chairman Powell. It's going to be interesting.
You know when you get the earnings and people start to trade and someone says, have you listened to the earnings call? And the call hasn't started yet. This is a two-part act.
Yeah.
And there's a new news conference that starts in 2 minutes, and it's going to be about the emphasis in that news conference. And can I also state that in about 10 minutes' time, about 12 minutes to be precise, the president's scheduled to speak as well. So you're going to have this really odd dynamic where the Fed chair is talking potentially about the pain still to come in this economy, and the president, at least the counter-programming ahead of the midterms, talking about an economy that's still doing okay.
Yeah, well, good luck. Honestly, I think that's really the question is how can he possibly counter program given that inflation is the primary concern for so many people, and that does seem to be the Fed's primary concern. How much was that additional comment thrown in there? Basically a nod to the moment of politics that we're in? How much are they basically saying, look, they're taking this into effect. We understand your point. We got it. We're doing our best. Got to get inflation under control. Thanks.
It's not the first time that the Fed chair's talked about any of these issues. I just don't think any of this is really that new at all.
Do you think this is a snoozer?
I think Neil Dutter of Renaissance Macro nailed it a week or so ago when he said all of this is implied in the dots. What happens in the next hour is one thing. What happens on November 10th, December 13th and CPI is completely another. That's going to set the stage for what 23 and the trajectory and the glide path into 2023 is going to look like.
We don't have time to banter, John. I'll be very quick here.
Always got time for banter.
Mr. Dutter
Thank
right
you.
now saying on the statement today, quote, Brainerd's thumbprints. That's what Neil Dutter wrote.
I agree with you, and most people do.
You know,
It's an echo of the speech.
John Williams maybe weighed in here, other monetary heavyweights. Loretta Mester of Cleveland may have weighed in on that. But I'm sorry, I was really taken by the force of this phrase, cumulative tightening.
They've done a lot of work, Tom, in a short amount of time. And they've done way, way more than most people thought they would do even 9 months ago. If you think about where they were 12 months ago, Tom, they still hadn't dropped transitory. They were still talking about transitory, and we were still waiting to see if this Fed chair got a second term. It was only in December they were forecasting 90 basis points of hikes in 2022, and we've just had a fourth consecutive 75 basis point hike. Then we get wrapped up in this and forget sometimes just how much expectations have shifted around this Federal Reserve in a really small amount of time.
To put this into perspective, there have only been 5 75 basis point rate hikes in the past 30 years.
The Federal Reserve chair walking into the room. Let's get over to the Fed chair right now.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Timmeros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions, and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And, you know, the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And you know, there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?